I'm Jack from Options Insight and welcome to Trading 101. So as we know, inflation has been mentioned quite a lot in the last year or so, but deflation is what governments are truly fearful of. The willingness to pass massive fiscal and monetary stimulus in the face of the COVID-19 pandemic was to truly stave off the chance of entering a deflationary economy. So what is the big deal about deflation? In this video about deflation, I'll be answering the following questions. What is deflation? Why is deflation bad? And what can you do about it? So then, what is deflation? Firstly, it's important to actually understand what the term deflation means. Deflation is when consumer prices decrease whilst purchasing power increases, ultimately allowing you to buy more things for the same amount of money. It's also important to note that deflation acts as the polar opposite to inflation, which is when prices are increasing. See my video on inflation for more details. Similar to the way inflation is measured, deflation is also measured through looking at the Consumer Price Index, where countries are able to compare the cost of a basket of goods and see that the price of those goods has declined in a given time period. Whilst out-and-out deflation is quite rare these days, which means an actual reduction in the overall price level, what we see more often is disinflation, which is the slowing down of inflation even though the inflation rate is still positive. For decades now, we have had structural forces causing disinflation in major economies. These include demographics. If a population is aging, then they will tend to earn less, spend less, and save more. This reduction in demand will stop prices from rising very much. Japan is a prime example of this problem. Next is debt. As consumers and governments accumulate more and more debt, as has been the case in recent times, the interest and capital repayments on that debt reduces disposable income and hence lowers demand for goods and services. Additionally, having less fiscal spending capacity makes it harder to pass stimulus bills through Congress if you have a massive debt burden. And thirdly, technology and globalization. The ability to outsource work in manufacturing to countries with cheaper labour and the innovation in robotics and AI has brought down production costs and increased supply, which also brings down prices due to increased competition. Other causes of deflation include tighter monetary policies, which might make people hold on to the cash they haven't spent instead of spending it due to rising interest rates. Another cause for deflation is declining consumer confidence due to economic events that bring uncertainty or fear in everyday life. Take COVID for example. People worried about unemployment or the overall state of the economy may choose to spend less money, which creates a downfall in the overall demand of goods. So then, why is deflation bad? Deflation can have several negative impacts on not just the country's economy, but also the livelihoods of the people that live there. Whilst your first thought might be that it's good for the prices of goods to fall, the true reality is much different. Firstly, high unemployment is usually one of the first warning signs of a deflationary economy, with companies trying to offset their production costs and falling prices, leading to lower wages and potential layoffs. Deflation also slows down a country's economic growth, as these higher unemployment rates cause consumer spending to slow down, reducing demand, which in turn negatively impacts companies' earnings. This creates what is known as a deflationary spiral. Another substantial effect of deflation is the value of debt rising. Whilst incomes often decrease, debt payments and other interest rates remain the same, meaning it will effectively cost you more to make these repayments, leaving less disposable income to buy goods and services in the economy. People that own lots of stocks and real estate end up getting crushed with their values plummeting, leading to a negative wealth effect, meaning they are likely to spend less money as they feel poorer. As you can see, in deflation, everybody loses. The desperation from governments to not go into a deflationary spiral was why it was relatively easy for them to pass enormous stimulus packages during the pandemic. In the last 100 years, there have been 3 significant examples of deflation. These cases show us the impact that deflation can have on an economy and people's livelihoods. Firstly, the recession of 1920 to 1921, right after World War I and the 1918 influenza pandemic, where the US saw the price of goods and services drop for over a year. Next, the Great Depression, which lasted from 1929 to 1939 and was believed to have stemmed from tight US monetary policy aimed at limiting stock speculation. During this period, the Federal Reserve raised interest rates in the hopes of slowing down the rapid rise in the stock market. However, sadly, this tactic failed, causing consumer spending to decrease, ultimately leading to this form of deflationary spiral. Additionally, the crash of the stock market led to a downturn in consumer confidence, causing factories and other businesses to slow down production, resulting in high unemployment rates and decreased wages for those lucky enough to keep their jobs. The last example was in Japan in 1991, which is often referred to as the lost decade, where asset prices plummeted due to consumers and producers overly focused on saving their cash, thus causing a deflationary spiral which lasted for years. So what can you do about deflation? In any deflationary period, which is usually short-lived nowadays, there are a few things you can do in order to protect yourself. Firstly, you can hold on to your cash as the value of that cash will have more purchasing power as prices drop. Secondly, you can layer yourself up with defensive stocks in your portfolio, with things such as healthcare and consumer staples. And thirdly, holding onto bonds as interest rates will typically go lower in deflationary periods will give you a higher return than if you were to only store your cash. Whilst these things help you pivot towards a defensive portfolio, you can also add put options, which should add that extra layer of protection for when there is a lot of downside in the market. In my future videos, I will explain exactly what put options are and how they can be used for portfolio protection. Governments are so frightened of deflation due to the mountains of debt they have accumulated over the past decades that any deflationary period will be quickly reversed with unlimited money printing. Similar to what we saw in 2020, the appetite for a prolonged period of deflation is just not there, and the central bank playbook has changed since the Great Depression. Holding cash in deflationary episodes will allow you to pick up bargains, but you need to be quick to buy them when you can. Whilst we may get some mini bouts of deflation that impact asset prices negatively due to the fact that everybody loses, it is in the interest of the people in charge to reflate assets by turning the money printers back on and debasing the value of money. Hence, holding cash for too long can be dangerous. In the end, they would rather it was just the poor people who didn't own assets that lose out, rather than everyone in the economy. Thank you for watching this video about deflation. In my video on Bitcoin, I discussed how many people see this as a hedge to future currency debasement, which is why we are seeing so much adoption towards this new exciting asset class. Please don't forget to subscribe and like. Also, please comment with any questions or feedback and what other topics you'd like me to cover next. I'm Jack, and this has been Trading 101.